It's finally Monday morning, and as we can see, Amazon is down nearly 3% today. And interestingly, this has purely come down to the fact that an analyst has given this company a downgrade, and that is the Wells Fargo analyst, who has also reduced his price target to 183 from 225. Now, as we can see, it is now trading around $182, and year to date it has performed fairly strong, up nearly 20%, and we believe in this episode, as we will explain, this to be one of the best valued companies in the S&P 500 to buy. So do listen, and as always, give us your thoughts below. There are a few other things that we do want to cover with this company, and if you didn't know, Amazon is using a lot of robotics within their warehouse. In fact, just over the last 2 years, we can see they have pretty much doubled the number that work within their warehouses. And why this is very good for shareholders, ultimately it helps improve on their operating margin and therefore helping with that bottom line, and in turn should show through the shareholder price return. Now, there are some other things that have happened over the last few months. For example, there was that deal between Intel and Amazon in terms of developing the AI chips, which was very significant, not just for Intel, but also Amazon, as they do start to move away from Nvidia. And something that we are still wanting to hear more of is the fact that Amazon are internally looking to create their own AI chips, which again will help on those margins that they have and reduce the reliance that they currently have on semiconductor companies like Nvidia. Now, when we go back and look at this company, we do notice a strong buy from Wall Street that has been there pretty much for quite a significant number of time. We see Seeking Alpha giving this a buy, and Quant, as we can see here, giving this a hold at 3.47, not too far off the 3.5 that would warrant a buy. We do also note it is down around 10% from the $201 52-week high, and currently trades at a forward P of 39.5. And for those that have been long-term shareholders over the last 10 years for Amazon, you would be up more than 1,000%, and that is a significant outperformance of the S&P 500. Now, when we take a look at this company in terms of moving forwards, they're anticipating some very strong growth to the earnings per share. In fact, the next 3 quarters, the expectation is double-digit EPS growth year on year. And looking back to the last 4 quarters, we have a 100% track record, so that is a very good sign. They did have a very nice speed as well in the more recent quarter of Q2. Now, that does give us faith they can hit their expectations for December 2025, and that will ultimately lower down that forward PE to 32.15. Now, in terms of their metrics, we always like to look at the free cash flow. We want to see consistent increases over the longer term. And whilst we don't see that, particularly in 21-22, we notice it has rebounded very strongly into 2023. And over the next 12 months, this is anticipated to continue the very strong upwards trajectory that we have seen previously. And from what we have read from management notes, free cash flow is something they do keep an eye on and are expecting to grow rapidly. As we said, with the deployment of robotics, reducing those margins, it will help this company moving forwards. We also see their sales growth nearly double digit every single year on the top line, 12% in 2023, always good to see, 12% as well on a trailing 12-month basis. And when we do zoom out and look at it from a numerical basis, 90 billion in 2014, 575 in 2023. So over the longer term, this has performed very well, and there are no reasons why we shouldn't see this continue into the future. Shares outstanding, though, we do have to point out they have diluted your position as a shareholder over the last 10 years, although very minimally on a year-on-year basis, so nothing much to discuss today. In terms of ROIC, whilst we want to see 10% or more just to give us faith management are able to effectively allocate their capital, it is consistently inconsistent. 10% in 2023, nice to see. 14% on a trailing 12-month basis, again nice to see. It would just be good moving forwards to see that 10% as a real bare minimum. As we've already discussed with their operating margin, we do believe with the implementation of robotics as well as moving away from Nvidia for these chips, including the partnership with Intel, their margins should improve. Looked very poor over the last 10 years. The only saving grace here is in fact that it has been increasing, and that is what we ideally want to see. We want operating efficiency and we want minimum that 12% level. Nice to note though, 9% on a trailing 12-month basis is an increase from 2023, And as we said, expectation from what we hope is to see that double digit. Free cash flow margin as well, minimum 5%. It is pretty much what we get bar the 21-22 period, 6% in 23, 8% on a trailing 12-month basis. Again, lots of numbers are very close from the borderline of what we want to see, so this is one that we do continually keep an eye at, but overall we do believe it to be a very strong stock. Net debt to EBITDA, earnings before interest, tax, depreciation, amortization, below 3 is what we want, below 3 is what we get, 0.61 in 23, 0.43 over the next 12 months. Remember, these are the number of years it would take the company to pay off all of their debt net of cash on hand, so it does look very good. Remember, it does correlate to balance sheet strength. So overall, no real worries with this company, but there are some metrics that we would like to see them improve and on a more consistent basis moving forwards. Now, we do want to let you know we have just released our latest free weekly article. It does come every single Monday, and we essentially discuss what's happened in the market over the last few days, as well as undervalued stocks that we do believe deserve your attention. So if you click on the pinned comment below, you can sign up, read these straight away, and you will have instant access to when they drop every single Monday. On top of that, you can grab a copy of 36 undervalued stocks for your attention for the month of October, where we also discuss those that sit within our own portfolio. And on top of that, you can grab the 22 dividend stocks that Wall Street analysts believe have the most upside over the next year. So don't forget, sign up, click on the pinned comment below, and you can read straight away. Other parts of our analysis include looking at insider and institutional movement. Insiders pretty high, around 11%. We do notice nearly 7 billion worth of sales just over the last year, although none in quarter 4. We do see around 1.22 billion in quarter 3. And when we see who these insiders, who these individuals are, we can in fact note that the SVP on the 24th of September sold around 2,200 shares. That netted him around 427,000, but we can also see both the CEO as well as the CFO having sold just over the last few months. Now, whether or not you believe this is a bearish signal, we just want to highlight this. What we're ideally looking for are insider buys, as we believe that is the bullish signal, because management buy if they believe the share price is going to go up. Now, in terms of institutional ownership, 72%, around 23 billion worth of sales over the last year, but we see a significant amount more buying during the same time period. What is interesting to note though, in Q3, we actually see the opposite. We see more selling than buying. In the previous 3 quarters though, we actually see more buying than selling, which reinforces institutions are buying more over the last year. However, in the more recent quarter, double the amount of sales than buys. Now, we've already discussed the top line revenue. We want to now highlight the bottom line net income, but just as a reminder, their revenue growth has been very strong and consistent over the last 10 years, going from 89 billion in 2014 to 575 billion in 2023. And the bottom line, does it follow the same trend? Well, we can see whilst it has been a little bit inconsistent on a year-on-year basis, over the longer term, it is moving in the right direction. They went from a net loss of 241 million in 2014 to a net profit of 30.4 billion in 2023. And on a trailing 12-month basis, we can see that expectation is to continue moving in the right direction. Then when we look at the balance sheet, which we already said looked very healthy in terms of the net debt to EBITDA, the cash, similar to other metrics like revenue and bottom line, have been increasing over the period, going from 17.4 billion to nearly 90 billion in the latest quarter, which, as we always like to do, comparing it to the total debt numerically and directionally, we can see that this value has increased, and significantly, as we can see from the graphical basis. But from the numerical, it really does point out 14 billion in 2014 to 158 billion in the latest quarter. Now, it is definitely something just to keep an eye on. We don't like it when the debt levels do increase at this very rapid rate. We do notice though from 2022 they have started to pay some of this off. But as always, we will keep an eye on some of these numbers, as the last thing you want to do is invest in a company where it goes from a very strong balance sheet position into a state where the debt does get out of hand. But so far, no worries for Amazon in that department. Then we want to take a look at some gradings. The first one, as always, is the valuation, where they get a T-. No surprises there, given that on a forward P basis of 39.45, it is significantly higher than the sector median of 17.1. In fact, right now, if you're buying this company, you're paying a 131% premium to the overall sector, and that is pretty much reinforced no matter which valuation metric you use. Now do remember, sometimes companies are warranted to be trading at a premium. The real question we ask ourselves as investors is what premium should we be paying, and we will cover that in our valuation shortly. We then move on to the growth, where it has an A-, year on year 12.3%, a lot better than the sector of 2. Moving forward, still double-digit growth anticipated of 11%, sector median low single-digit of 3.25. And one thing we do like about this company, earnings per share over the next 5 years, expected growth 22%, as we can see in comparison, the sector median 10.65. Finally, we look at the profitability. Always great to see an A+ on that figure, and we note that the gross margin of 48% is better than the sector overall of 37%. Bottom line, looking decent at 7.4. It is marginally better than the sector of 4.63, but the main takeaway here from Amazon is their cash from operations, 108 billion, as we can see in comparison, 285 million for the sector. In terms of a quick recap for this part of the analysis, a buy from Seeking Alpha, a strong buy from Wall Street, a hold from Quant, D- on valuation, A- on growth, with an A+ on profitability. Now, last thing before we jump into the valuation, how has Amazon compared against others in the broadline retail industry? Well, as we can see here, over the last year, this company is up around 43%. Whilst it's pretty much within the competitors, we do know the overall market has performed very, very strongly. And over the last 5 years, when we do take another comparison, we can see it right in the middle, up 109%. When we zoom out even further, over the last 10 years, we can see one of the best, up more than 1,000%, pretty much second, as we can see here, Mercado Libre up 1,722%. Whether you think that's good, whether you think that's okay, do remember that the past performance will not give us any indication to the future, just one level of analysis we do incorporate. Now let's jump into the valuation model. As always, if you do enjoy the content, value is being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now our intrinsic value of $226 has come from the DCF model, and when we do take a look, we've essentially got the free cash flow year on year. Average growth rate, -3%. It is skewed, as we can see. Some years go from a negative to a positive. And moving forwards, we've gone for a 20% growth rate. We have a low, medium, and high, 15, 20, 25. With the 20% and the discount rate at 8%, we get the present value of future free cash flows and terminal value. We add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and as we can see here, an undervaluation signal. Now remember, these numbers are subjective. You can click on the pinned comment below to grab a copy of this model to run your own numbers through, whether it's Amazon or any others. But just for full transparency, as always, we will show you for those that believe 20% is too optimistic. At the 50% level, we get intrinsic value of $159, indicating downside of 12%. And for those that are thinking this is way too conservative, at the 25% level, we can see $319, indicating 76% upside. As we mentioned though, we will take the median rate of 20% into the next slide, and this ultimately gives us our intrinsical DCF value of $226. Now with the current price at 181, we always like to add a margin of safety of 10% to begin with, and we only execute on this if it meets the 3 criteria: wide moat, strong financial metrics, and good forward-looking data. Now if you believe that in today's episode, a buy up to $204, then we keep going till it's near the current trading price, and we can see today we believe Amazon has a 20% margin of safety at the $181 mark. Now that is a very good margin of safety for what we do believe to be a high quality stock, but as always, do give us your thoughts below whether this is one you are considering, maybe on the watch list, or maybe this is one that you are in fact selling. What we also notice is that Wall Street have a very similar target. Their price over the next year, they believe $224, where they see upside of 24%. As we already saw at the beginning of the episode, they have given this company a strong buy. Now, for those that just want to know, at the 25% MOS, it would be around $170. At 30%, around $158. But as we said, today's episode, 20% margin of safety with 24% upside. As always, do give us your thoughts below. If you enjoyed today's episode, smash that like button, hit that subscribe and bell button. Don't forget to click on the pinned comment below, sign up to the free weekly newsletter, and come and join us in the Patreon where we do talk about our weekly buys and sells. As always, have a great day, and we'll see you all on the next one.